Good day. This is the Elliott Wave weekly update for the S&P 500, being recorded on Saturday, September the 14th, 2024. I'm going to begin with the SPX, the cash market, and I'm on the wrong chart. Get up to the weekly 3-year chart. And there's nothing really for me to be adding to my longer-term picture because it remains exactly the same. Our point of focus has been and remains the minor fourth wave that may be complete, that may still be underway. And so, as I did in the NASDAQ, I want to basically go over similar scenarios that could take place here for the S&P. Now, first things first, when I switch over to the futures market, the ES, that Thinkorswim has already gone out and is now putting up front the December contract. Basic reason, next Friday is the monthly expiration. Therefore, the futures markets will cease. The September contract will expire next Friday. And usually about a week before, due to the fact that we're going to see a lot of contract rolling out of what's left in the September contract, will either be closed or rolled out to December. So we'll see that take place. Now, if you're trading the futures market, then you may choose to kind of do what I'm doing, and that is I look at the ES and I see, well, as soon as I pull the data, where and who has larger volume. And you can see that December contract is actually, it's about 2-to-1 right now, 2 in September, one for December. But when this volume gets greater than September, then I would officially switch out. And the reason being is that the market gets very thin and gets pushed a lot quicker in that September contract. Less volume, not a good deal. So you're going to want to stick with the higher volume. And it's likely, could very well be, come Monday, it could very well be that December contract. So, and there is approximately $51 right now premium in December over September, $51. So that just goes that there's always going to be interest that you got to pay because it's a futures market. And if you're doing it on margin, it'll cost you. So that's the $51. Back to the cash market. So stopping it off, everything remains the same, and that the minor third wave completed on July the 15th at the high of 56.69.67. I'm going to round it up 33 cents to 56.70. So the objective here for once we're in minor wave 5 is to exceed that high. Now, let's take a look at what we have thus far. The high thus far, which was put in on August the 26th, was 56.51. We'll even give it the 38 cents there. I'll mark it up to 56.52. This was 56.70. So we're within a day, a good solid up day, and we're producing new highs above wave 3. So that kind of limits what I think we can happen here to basically, in my view, 2. And the first being is like, if this is wave A of minor 4 and this is wave B of minor 4, this market needs to turn and drop now, starting tomorrow in the cash market, starting on Monday morning. We need the gap lower, as a matter of fact. So the cash closed Friday at 56.36. Mind you, 56.70 is what it needs to get above to officially kind of tell me we're within that fifth wave up, the minor fifth wave. Now, before I have to come back and eat my words there, we also would have to consider here, being that it's a fourth wave that may still be in progress, that it could turn into an irregular. Now, if that's the case, let's just say that I'm now going to add we're going to go from here, and yep, I can use this. We can go from there and take it back. You got to hit the right ones, right? There, down to there. And I'm going to go here and put there, and I'm going to add 1, 2, 3, 6, and 1, 3, 8, 2. Get rid of all those because they don't be needed. And so we have the possibility, if it's going to be an irregular B wave, right? We've done the A, we're going up in the B. Irregular B wave allows for the market, 1.236 is 57.99 or 5,800. 1.382 is 58.79 or 15,880. Now that, seriously, the market could go all the way up there and swing all the way back down and get itself back down to 49.58. That could happen. Now, so let me rephrase 3 potential possibilities going on here. I'm going to leave this one as the first, that we actually do get above 5670 and we start heading up towards 5700 and get above 5700. We can go all the way up to 58. So that level is 5804 actually. And then we have 5879 or 5880. Those levels could be reached, and still, if it comes back up in 3 waves. So that could be an A, a B, and we're flipping up in a C wave to get up there and still turn around and nosedive. Possibility number 1. Now, I'm going to get rid of that. What we also have is that it's an ABC and minor 4 is right here. And what we now have, and I'm going to bring it out of this weekly chart. I'm definitely going to bring it out to the weekly chart. Let's take it down to the daily chart. So here, this really, to me, we can call it AB, and we can call it a C. That we can do. But we also can say A or 1, 2, 3, 4, and we're in wave 5. This is scenario number 2. And if indeed it is, first thing I'm going to do is take this out, and we would put this, and let's say this is 1, and we're going to come over here, and I'm going to put in just the fibs, which is comparing 5 to 4, and it's going to come in right there. So look where that is. 1.618 is 57.15, definitely above 56.70. And then we could have 2.618, which is 59.08, and that gets us right up close to where intermediate wave 3 would be completing. And that show pretty good strength that we could already be in minor wave 5. So I'd have to put the minor 4 there. And we're going to fly up higher under this particular count at 1, 2, 3. This is 4, and we're coming up. Now, that works in the SPX. We're going to double check just to make sure that that also can be the same in the ES. Because don't forget, the ES trades prior to the New York opening and after the New York close, whereas the XPS does not, which is why often we get gaps all over the place. So there is second. Now the last is, and I'm going to take this off. The last is that, and if you missed that, just rewind this a little bit, come back and copy those down. And the last scenario that I think that we can apply is going to be, what if this is A, B, C, and it is a B, and this is 1, 2. Very, very close to being a flat 2, but still could be acceptable. What would have to happen is we could not gap up anywhere tomorrow on the opening. Monday on the opening. We can't gap higher. We'd have to gap lower and then keep going. And that would then suggest that it's an ABC and we have a C wave going down. And if that's the case, we turn around and we run our fibs going back in the other direction for wave C. And we have 100% at 5,100, which, by the way, gets us below 5119. That's all the C-Wave has to do. Now, mind you, that also would put in here, this would be an absolute ABC flat for minor 4, right? We're so close to that high, we'd be so close to that low. Basically, the 20-point difference, 5670, 5650, 19-point difference. And to the downside, this low is 5119, minus 19, 5100. And that would bring it down. Now, could this literally happen? It can. And if we really take a look, it's like I explained in the NASDAQ. The S&P and the NASDAQ have both been flipping back and forth between negative gamma situation or risk off trades to positive gamma or risk on trade. And it did it here. It flipped back to risk on here, flipped back to risk off here, flip back to risk on here. Actually a little bit lower, actually about right there. So 5,500 is where it flipped back, and 5,500 is where it flipped below. So it gets kind of crazy, right? There was a big to do at 5,600, but yeah, it caused a nice little drop, but they quickly moved that wall back down to 5,500, and then when it broke that, it quickly dropped to 54, which was a definitive, please do not break this level. Because had it broken that level, we would have been heading back towards 5,100 pretty quickly. Because it would have been a much, much, much stronger risk-off type of trading. But save the day. We reached it and we rallied strongly up off of it. So that leaves us basically with those three. Now, what do we have coming up? Well, of course, we've got some numbers that are going to come on. Now we have some PMIs, we have some purchasing managers indexes. We got a few other things coming up during the week prior to Wednesday. Wednesday, of course, is Fed Day. Now, the market basically has already baked in, got it all set up. We will get a 1/4 point cut on Wednesday. That's what the market is basically stating. But here's really the choices. Is it going to be 25 basis points? Or is it possibly going to be 50 basis points? Or the third being the Fed does nothing. Now everybody's going like, no way, no way, no way, no way. Fed's gonna cut. At least we're gonna get something out of this. And they're putting so much into it without even realizing that just because you get an interest rate cut of 25 basis points does not mean that the bullish picture just really hangs on and sticks with it. Because if it only comes in at 25 basis points, it could be they bought the rumor, you sell the fact. And if we get a 50 basis points, that would be a surprise. You buy it. If they do nothing, you get out of the pool because the sharks are coming in for the attack. And that's the three scenarios that I think that can really impact our market. And only one, the surprise that they cut 50 basis points instead of 25. I think the other two, the 25 basis points or nothing, produce negative to an extreme negative trading situation. Now, that's just my opinion. I think that the market is kind of just really getting beyond itself when they're just really tooting in the narrative, lower interest rates, it's lower interest rates. Really for us as a consumers, a 25 basis point cut. Oh yeah, well, we're already seeing those real estate, the real estate that mortgage rates are coming down. Oh, they're coming down in advance of this. It's like, okay, so they're coming down from 7.5 to 7. So it's a start. Don't get me wrong. But to be tooting it, and saying this is the best thing since sliced bread, or this is all bullish, keep the rally going, I just think it's a narrative that doesn't need to be told. So in all honesty, I know I've talked about it several times during my daily updates, that I really put a lot of emphasis on the flows, the capital flows, the option flows, the gamma. And those levels continue to be extremely important as a trader. When I see those levels broken, when I see the market move, like particularly the volatility trigger, when that volatility gets triggered to, say, for example, it sits above the market, they go up and they take it out, and then they keep going, that's a trigger, and it's a trigger for the risk on trade. Now, right now, the volatility trigger, and let me just double check for the S&P, where it is sitting. I move that and go here, and move that back. In the SPX, the volatility triggers at 55.15, 55.15. And just below that at 5,500 is where we have some large gamma positions. Just above it at 5,550, and this is in the cash market, we have the largest gamma accumulation. Now, being that this is below the market, I am saying that it's short puts. And if that gets taken out, if it gets smacked and taken out, it should be a quick trip down to that volatility trigger. But it is the volatility trigger that's actually going to create the risk off trade. That'll be the announcement. It may start at 55.50. Don't get me wrong. Don't get me wrong. But it's the volatility trigger that actually puts it into place in terms of risk on, risk off. So here we are, 56.26. And so 55.50 is just a solid down day, which we've seen. We've now seen up 80. We've seen down 100. And basically both happening without a whole lot of pushing from the market, except that we're seeing certain component stocks getting hit pretty hard. And again, it's usually quite often related to breaking a level that triggers gamma and all the way around. So that's why I really do find that the information that is provided by Spot Gamma, and unfortunately you have to have a subscription, and rightfully so, because this is valuable stuff in my mind, improves option trading. But also I've now watched and traded off of when these triggers get triggered, you can see what starts to happen. And then you start to apply what you're going to do. You trade accordingly. And they turn into pretty profitable trades because the follow through on a volatility trigger, either up or down, can be quite sizable. So it's much easier to hang on to a trade. Just saying. Now, so laying those three out, let's take a look. We're on the daily. I want to take a look at the moving averages, but then I'm going to give levels to the upside. So we're going to see how easy we can get to finish this intermediate wave 3. And to be honest with you, the SPX and the ES are much closer than the NASDAQ is in terms of getting to new highs and being more convincingly putting in a minor fifth wave up. But again, just remember, please go back and review what I said about the irregular B wave, because we cannot discount that. And the reason we can't discount it or count it out is because of what controls both of these indexes is most of the time the MAG 7, which of course is going to have a heavier toll on the NASDAQ than it is on the S&P, but it definitively does have a hold on both. So here we are, and the moving averages. This is after 1, 2, 3, 4, 5 pretty solid up days. 200 meandering, slight upward bias. The 50 pretty flat, but a slight upward bias. The 13 just now crossing the 20, actually did it probably as it started Friday or at some point on Thursday. Nothing to really go like, wow, that's pretty convincing that the upside's got a lot more to do. This is why I sort of keep leaning towards, RSI, right? We're just 70 points away from this high, which actually would produce a lower RSI reading than this high. So the strength is not strong as they keep pushing and pushing. Maybe after the Fed, we'll finally get, one way or the other, the strength for market direction. Mind you, I said market direction, not for upside. But that's kind of where I'm going to leave all of this, because we're now waiting. We're now in the wait and see. Not so much if. I think now it becomes how much. Or surprise, not at all. And again, I'll just review quickly what we got coming up economically next week. Monday, we have the Empire State Manufacturing Survey, so that's a PMI. Tuesday, we have retail sales, industrial production, capacity utilization, business inventories, home builder confidence index. Wednesday, housing starts, building permits, FOMC. 2 p.m. Eastern, that's the big deal. And then Thursday, initial jobless claims, Philly Fed, existing home sales, U.S. leading economic indicators. Now, that if we weren't having a Fed meeting, I say that U.S. economic leading indicators normally would have a pretty good effect, one way or the other. If they're continuing to improve, showing us that inflation truly is on the downslope, then I think that could be very interesting for a Fed meeting. But since the Fed meeting comes the day before, I'm going to say they already know that number. They already got that one. And then Friday, there's nothing scheduled. So those are the three that we are either this is done and we are already in minor wave 5. And in fact, 1, 2, 3, 4, we're in wave 5 of minor wave 5. Here we have, you can see. Now, let's just going back on that daily. Yeah, I can do that. Let me open this up and go here. And I'm going to add just if indeed. See, it doesn't come in. You can see it starts to really kind of die out. But we do get above 56.90. Now, 1.618 is 57.15. 2.618 gets us up closer to above 5,900, and that's where that intermediate third can complete. Mind you, minor wave 5 will complete intermediate wave 3. I'm going to take it back out one more time to my 3-week. Here's intermediate wave 3. It's been in progress since December of 2022. And the minor 1, 2, and 3, we've maybe 4 is already in. I'm leaving it there. I've discussed it prior, and we'll find out pretty quickly. But at 4, and then all we need is that 5, and then we're completing intermediate wave 3. Now, the important thing to remember is that once intermediate wave 3 is complete, we get to have an intermediate wave 4 correction, which is going to bring us back down to the same levels we're just talking about now. Back down to here, because wherever this minor 4 ended, and it's likely would have to be here right now. If not, we're going to come down. I'm going to put it here, which is basically the same area. Intermediate wave 4, so no matter where, if it stopped here or if it finishes up here, we'd be looking for intermediate wave 4 to bring us back down to here again, and then turn and rally one more time in an intermediate 5th wave, again to new all-time highs, again likely back above wherever it finishes here and then some. So there's a lot of good trading that I think is coming. And I think we might get a lot of good trading next week, just trading what happens leading up to and after we know what interest rates are going to be doing. So I'm going to kind of finish it right there. I did get a little bit more involved in the NASDAQ. If you want more of the details of some internal stuff and just, the Fed and other things that go along, give a listen to there. And the next Elliott Wave daily update will be on Monday, September the 16th. Have a great balance of the weekend, everybody. Have a great trading day on Monday.